Hey everyone, welcome back to Virginia Venture Connect. My name is Justin Ritter, co-host of the series with Steve Keeler. Steve could not join us today, but today I have with us Tom Weithman, the Managing Director of CIT's GAP Funds, as well as the VP of the newly created Virginia Innovation Partnership Authority Investment Division. Tom, thank you for joining us today.
Justin, glad to be here. Thanks for having me.
Yes, well, I for one am very excited to chat with you, and I hope everyone out there enjoys this content as well. And it would probably be best at this point to talk about your role as the managing director of the CIT GAP Funds. What exactly is that, and how can it help founders throughout Virginia?
Well, we have CIT GAP Funds as a strategic venture fund supported by the Commonwealth of Virginia. Other states around the country, Massachusetts, Connecticut, Maryland, Pennsylvania, have funds similar to this, funds that are underwritten by state money that help to be catalytic in developing new companies within a given state, that help create new jobs, promote new tax revenues, and help spin out a number of other positive externalities that are beneficial for the long-term economic development of the state. In terms of what we've done at CIT GAP Funds, we're an initiative that is about 15, 16 years old now. We invest in three basic sectors: tech writ large, clean tech, and then in life sciences.
Very cool. And in these GAP funds, what when you're investing in various startups throughout Virginia, what are the average check sizes that you're writing?
Well, if you think of our CIT GAP Funds program, you probably think of us as an average check size of 100K, 200K tranched at the seed stage of investment. Now, we can drop down through a couple of other funds and invest a little bit less. We have the Virginia Founders Fund, for instance, in our Innovation Fund, which typically deploys checks at 50, 75K. And then the GAP Fund, which follows on, the companies in which we invest the smaller amounts, we anticipate will graduate to investment by our mainstream GAP Fund investments in tech, in life science, and in clean tech. Then actually by policy, we top out at 500,000 into any individual company.
Okay, very cool. And to give the crowd the audience some background as to the GAP funds, and Tom, correct me if I'm wrong, but based on the most current information I have, the GAP fund has deployed about $32.5 million of investment for startups in Virginia. Is it beyond Virginia, or is it only for Virginia startups?
No, we invest in Virginia. We're capitalized almost exclusively by the Commonwealth of Virginia to invest in Virginia companies that are headquartered here, that have an office where the C-suite comes to work every day, and have an express desire to grow strategic operations and technology skills within those boundaries.
Okay, cool. And that $32.5 million investment is deployed across 240 portfolio companies of Virginia startups. Worth noting that 86 of those are in the field of cybersecurity alone. And what I find interesting in particular is that these investments have created approximately 6,500 new jobs throughout the Commonwealth of Virginia, which I think is just awesome. All the funds collectively have raised about a 1.6x return since the very beginning, back in 2004, I believe, of the first fund, with certain funds in particular already having a 4x plus return. The one other thing I think is pretty neat is that the GAP fund, and Tom, maybe you could elaborate a bit on this. You are not only a helpful investor for founders and startups throughout Virginia, but you also help bring in outside investment to these startups as well, some to the tune of over $1 billion over the lifetime of all these 240 portfolio companies. Could you elaborate a bit on that?
I'd be delighted to elaborate on it. Thanks for that question, Justin. So, 240 companies seems like a lot of companies. $32 million seems like a lot of money, but spread out over those companies in this geography and over a period of 16 years, it really isn't that much. And that probably runs to the nature of what it is we do. And if there's one word I think that I want the audience to take away as being ascribed to CIT GAP Funds, it is catalytic. We are catalytic capital. We seek to bring a small amount, relatively small amount of scarce Virginia dollars to bear in companies where we can have affect positive influence on the company and their growth path, to try to accelerate their growth, their development of the company, their entry into the market, their acquisition of new capital, their hiring of new people, all of which spins off these great positive externalities for the Commonwealth in terms of the jobs that you mentioned, both jobs that are directly with the company and those that are induced in services sectors just by the growth of a company within the Commonwealth of Virginia, new tax revenues for the Commonwealth, new skills that are being brought to bear within the workforce. So we're very excited about all of that. As a part of that, being catalytic capital, again, we go back to this notion that's gained popularity in impact sectors. I think the Rockefeller Foundation coined that term. We were doing it before we even knew we were doing it. But we put out a little bit of money and try to recruit other money around the dollars that we put out. So if you look at the average round in which we participate, we can go it alone. We can lead. We can be the only money into the company if we can put a meaningful amount to work. More often than not, however, in helping the company to size the critical amount of capital they need to raise at any juncture, we know that we have to partner with them in recruiting other capital. So just as we don't start companies, the founders start companies. We don't raise the money. We can help founders raise the money. And so through a combination of our ever-expanding network and the Entrepreneurs Network, we help to recruit other money around ours that can, and we do a number of things to help do that. That's a very important part of who we are. And we've been relatively successful at that. As you mentioned, since inception, we've seen about $1.1 billion worth of third-party capital come onto the balance sheets of companies in which we've invested. Some of that's concurrent, a lot of that's downstream as the companies grow and take on larger venture rounds. And also important to note is, by our best estimate, about 80% of that comes from outside the Commonwealth. Neither a good nor a bad thing, just where the capital is coming from. But it's good to have that money coming into the Commonwealth to build companies here.
Yeah, very true. So if I were a founder listening to this video right now, I'd say, well, that's great. You can cut a check up to $500K with the understanding that that's on the highest end. That's not every investment by CIT, but any insights or anything you'd be willing to share about pre-money valuations for a lot of your seed stage investments for these startups? I mean, would you say at the very least that you play between the 40-yard lines, which is a term I like to use, which is just, you use reasonable terms within your opinion so that it would entice a founder to accept your investment?
Yeah, I think that's right. And just to be clear on our check size, we're not going to stroke a check for $500K. What we will do is stroke a series of smaller checks that can cum up to $500K. But we do tranche that around growth of the company, and anything beyond our initial seed investment, we generally are requiring some sort of validation by a large angel round or a VC round, and we are participating in that to validate our position in the company. So in terms of more specifically of your question, restate that for me again. I'm sorry.
It's really, if you could just shed some light on pre-money
valuations. Pre-money valuations, sure. It's interesting. When we started out investing with CIT GAP Funds, we did uncapped convertible notes. That is to say, we would write, debt financing, and it would not be capped. We completely deferred discussion of valuation till more mature money came in downstream, and we haven't done that in quite a while. It's very, very rare now that we will do an uncapped convertible note, and where appropriate, we will, we'll lead a Series seed equity round or look to be in a priced sort of a circumstance. And we've seen valuations change, of course, over the years. At present day, they're probably on an upward drift. I would have told you 3-4 years ago that, you were probably in lockstep with what the numbers the Angel Capital Association was putting out, that we saw mean valuations in this part of the country, about $4 million at the seed round or for an angel financing. And that's where we're comfortable. And occasionally we'd see something a little above, occasionally we'd see something a little below, but that's pretty much where it stood. I've lived through now, I thought I was going to see my third cycle here with the onset of COVID. I lived through nuclear winter after the internet bubble burst. I, was participating in this game in the the Great Recession of 2009, and I would have told you, looking back to the March timeframe, that we would have seen valuations take a significant dip. We haven't seen that. I think that's going to happen. I don't know what collection of forces will induce that, but there's some correction in the offing. But at present, there's a pretty large overhang of institutional capital, and that trickles down the food chain, and exerts upward pressure on pricing. So we are valuation conscious. We invest for both impact, that is to say, good economic outcomes for the Commonwealth, good economic development benefits for the Commonwealth, but we also have a requirement to invest for return, and explicitly that is to return the fund. We're a little above that at 1.6x, as you mentioned earlier. But we are conscious of valuation. So we want to see where our money can become meaningful. And if we have an entrepreneur come to us that seeks to raise $3 or $5 million and on pre that is 10 or above, we have to step back and wonder what difference our small amount of money is making. So we tend to participate where at a lower, more manageable valuation, where our money can be critical to the growth of the company.
Cool. I appreciate that. Switching gears just a little bit, are there any industry groups, Virginia specific, that really excite you right now as far as new investment for CIT?
So in terms of industry, you mean companies in which we'd invest, or industry groups? Because I see a lot of industry groups that are around supporting entrepreneurship and the development of new technology throughout the various ecosystems of the Commonwealth that are exciting as well. If you're talking sector specific, I've got a few ideas. Sure, in terms of sectors, you pointed out earlier, we've done a lot of cybersecurity. We've done 86 companies in cybersecurity. We've been one of the most active, if not the most active, seed stage cybersecurity and investor in the country with broad exposure in that segment and various subsectors of that market. We did that through the Mach 37 accelerator, in which CIT was a participant for a number of years, and through our traditional CIT GAP Funds portfolio. Given our proximity to the federal government, given the ever-increasing nation-state threat that we see as a force in that market, cybersecurity is likely to be an ongoing area of interest for us. There are other areas that I would term kind of roadmap technologies, those that we see aligned with Virginia's technology roadmap is constructed a couple of years ago. Things like data analytics, data-intensive enterprise applications, which now invariably involve an element of machine learning or AI. They're very exciting. We see a cluster emerging, and we see other parts of CIT very heavily engaged in unmanned systems work. We see that as an emerging area, kind of a frontier technology. We've seen some interesting things in satellite communications, and those are the areas where we've probably had our strongest returns. Now, that said, don't discount life science. There's some great things going on in life science, largely in central Virginia around kind of the UVA VCU axis, although we've been in a couple of interesting plays in Hampton Roads, Northern Virginia, and Blacksburg along the way. There's some very interesting things going on in life science, and that thing has just gotten a whole tailwind from COVID.
Yeah, very true. Very true. Two final questions as our time's starting to wrap up here. First, perhaps could you give your anecdotal and historical perspective on startup investment in Virginia since your first fund of 2004 all the way until today, 2021? What was it like? What changes have you seen? What do you like now, and what should improve?
Sure. What's changed a lot, now we're doing money transfers to companies. We used to just, etch out the investment on stone tablets. So we've seen a great amount of change in the time I've been involved with it.
Yeah.
In all seriousness, though, we've seen changes across the country in terms of the environment in which early stage investment is made. We've seen it in reference to the way technology is developed and deployed as things have transferred to the cloud. We've seen a marked increase in sophistication among early stage investors. We've seen, as you mentioned, as we talked about earlier, valuations fluctuate. They come up, they come down, but generally they've gone up. Capital has moved upward to the right. We've seen traditional venture move a little bit downstream, and other types of organized capital or disaggregated capital move in to participate. That makes, I think, renders the work of the CIT GAP Funds, a federal SBIR program, the number of angel groups that we see around the Commonwealth increasingly important. And I can't say enough about the development of angel investing and new company acceleration around the Commonwealth of Virginia. We see this in virtually every region. We see 757 Angels, 757 Accelerated Hampton Roads. We see some great things going on with Lighthouse Labs, Trolley Ventures, and others in Richmond. We see the Charlottesville Angel Network, the work of iLab in Charlottesville. We see RAMP and new Commonwealth Angels in the Roanoke-Blacksburg area, and the list goes on. So we've seen a real adoption, a real groundswell of support for the entrepreneurial economy across Virginia, and increased interest in tech transfer, outbound tech transfer and commercialization from Virginia institutions of higher learning. All very heartening, all very positive. So we seek to build on the legacy base that we would have had in the early 2000s around the federal government and in Northern Virginia, but with other fantastic things happening virtually all across the Commonwealth, involving so many players, so many dedicated.
Yeah, well, most appreciated. Last question, somewhat related to your anecdotal experience. You must have relationships with many founders throughout the Commonwealth, and I'm just wondering, what are you hearing or seeing any patterns of specific pain points that entrepreneurs are having, things that you think need to be improved, or perhaps things that you've seen actually improve over time that you'd be delighted to report?
So in terms of things that I see being improved, I see, I mentioned increased sophistication in early stage investment. I see an increased sophistication in terms of the entrepreneurs that we see, generally speaking. And I think that is a function of stronger support services, a greater prevalence of early stage capital around the Commonwealth. I also think it's availability of information. I think it's a proliferation of the promise of entrepreneurship in public literature and in institutions of higher education. So I think that is heartening. I think that we continue to hear entrepreneurs that are struggling with capital raise. And I think there's a persistent capital gap in the Commonwealth and likely in most states. And I think there, in the foreseeable future, there will be a place for action of the government, either directly by investing or indirectly in the case of a BIP or CIT, to put capital out to help meet that capital gap, that valley of I think that gap shifts, it waxes and wanes over time. But I think it persists, and there will always be a place, as far as I can see, for CIT GAP funds to participate. However, I'd like to take, in closing, a more segmented view of the entrepreneurial market, because we see that not all entrepreneurs have equal access to networks, critical networks that provide the level of sophistication that enable them to build business, or know where to go for capital, or where to go to build a high growth business. That's part of why we started the Virginia Founders Fund about 3 years ago. We took $3 million from returns from our legacy CIT GAP Funds, our flagship program, and we potted in this special fund really to shine a spotlight on founders, high growth entrepreneurial situations in traditionally underserved communities, defined both geographically and demographically. So think areas outside Northern Virginia that wouldn't typically see risk capital in much plenitude. Think women, minority founders, veteran founders. We think there's a lot more to do in that area. And from our dialogue with traditionally underserved founders, we note that there is a sense of disconnectedness from what is perceived as the more robust networks that some other founders have access to. We want to improve that.
Tom, thank you so much for sharing your insights and knowledge today. This was fantastic. I learned a lot, for one, and I hope everyone out there did too. Thanks for spending the time with us today.
Justin, thank you very much. I've enjoyed it.
Me too. Thanks.